There's not really any way to avoid these. We have racked our brains quite a bit and tried to come up with something, but there doesn't seem to be a consistent way to know when a momentum is going to happen right at the end of the run. So some things to look out for that may help you. Now, these are not 100% guaranteed to disqualify the losing momentums every time. Divergence in the blue line, even though we may not have a full setup for a divergence reversal, this kind of lets us know that the overall momentum of the trend may be kind of running out of steam. And also another thing is if the blue line is up at an extreme when that trade qualifies, that can give us some indication, but again, it's not a 100% way to disqualify these momentums. But I don't like to shy away from losing trades. We're all going to catch them. And I actually like, especially in the debriefs, but even just these training classes, to show losing trades happen first thing in the morning, because I think it would be common for a lot of people to catch a losing trade first thing in the morning, the first one or two trades, and can be completely discouraged for the rest of the day. And I really like to just confront that and try to tell people that it's okay, because if we look at this, I mean, if we get discouraged every losing trade, we're going to have a rough time, because there are going to be losing trades. There's going to be days where there's back-to-back losing trades. So we have to be mentally and emotionally prepared for that, because that can really start to affect our judgment when trading. And, you know, it's easy to say, oh, trade like a robot, this and that. And we don't mean trade completely like a robot, just following the rules. And while we do want to follow the rules, but, you know, just checking off the checklist without taking into account market conditions and things like that. So the advantage we have over automated trading programs or things like that is that we can trade like a smart robot and make more intelligent decisions based on what the other indicators are telling us. But what we really mean when we say trade like a robot is we have to be emotionless. And I really think the people who can trade with as little emotion as possible are probably some of the more successful traders, because you don't get totally discouraged by a losing trade, and don't let it affect your judgment for the rest of the day. You just stick to the plan, take your qualified trades, and with a win ratio that, you know, is right around when we have 75 to 80%. Some of these trades are quite a bit higher, but, you know, with that win ratio, taking every qualified trade, you're going to end up ahead. And our money management strategy is designed to capitalize on that. So, and while I do like to show ways to try to avoid losing trades, that's not always going to be possible. And, you know, adding some more discretion into how we trade inevitably is going to lead us into situations where we pass on trades that end up winning. But the thing we have to consider about the trade-off is, if we can, say we can avoid 3 losing trades and we let one pass us by, well, those 3 losing trades, that, you know, that's 2.5 trades, each losing trade that we don't have to make up for now. So, you know, if we can find a good way, whether it's recognizing chop or not trading into the 200 or not trading into the high of the day, if we can find ways to avoid those riskier situations, overall it'll go a long way to increasing our profit potential in the long run. So even though taking every qualified trade does result in net profits in the end. I think doing that, you may encounter periods of drawdown more frequently. So that type of thing really depends on your account, what your daily goals are, um, your daily profit goals, and things like that. So I always think it's a good strategy to when first starting out, especially if you don't have enough of a cushion where if you have a rough day or two, it's not going to completely discourage you. Is start with a small profit goal. $200 or $300 a day, maybe even 500, but really depends what you're aiming to do. And then just shoot for that goal every day. And then once you hit that goal, you can either make the decision to stop for the day or, continue trading. So, but I think consistently making a daily profit goal goes a long way to building our confidence as traders, as well as in the system where you can consistently see gains. We may not be knocking down, $2,000 every day, but small incremental profits will eventually start to snowball. And Todd actually likes to, every $3,000 in profit added to the account, tack on another contract. So, and we always favor 2/3 being taken off at profit target and 1/3 or the remaining being left on with a runner. So if we start with 3 contracts, say we're shooting for $200 a day and we manage to hit $200 a day every day, and then after 15 days we'll have hit our first $3,000 mark. So we add a contract. Now we have 4 contracts, 3 being taken off at our profit target and 1 left on for the runner. So not only are we going to hit our daily profit a little bit faster, we may want to increase the daily profit goal, maybe by $100, maybe by 200, whatever makes sense for you. And then you'll find that you'll hit your next $3,000 mark quicker. And then now we have 5 contracts we're trading with quite a bit more cushion. And we have 3 taking off at profit target, and now we have 2 runners. And that's where things really, I think, start to reach a different level, is once even just the 5 contracts, but you have 2 runners. So any of these longer runs that you hit, I mean, these are just going to be double that profit, which can be quite significant. Hitting any of these profits that were, 120, 130, I mean, double that, that's pretty good for a single trade. And then, after that point, it really starts to snowball. So if you keep following that strategy of trading, of adding a contract every $3,000, once you get to that point where you're trading 5 and have 2 runners, then it's really off to the races. I mean, of course, we do risk more for the losses, but the profit potential is just so much more that it's really quite an effective way to trade. And you may take a loss, and now we get stopped out on 5 contracts, and it seems like a big hit, but then you catch a run like this in the NQ, which really just took off as soon as this qualified. I mean, this thing just took off, and you're talking I mean, 19 points, probably like an 80 tick trade here. So quite a bit of profit. So, and depending on which money management strategy you're using, can depend on how much profit we get. So I'll just run through the different money management strategies real quick, and just outline the differences and why I like widening our runner to the DPI price rather than trailing at the higher low of the previous bar. So maybe when you're first starting out, trailing at the higher low of the previous bar uh, is, it's pretty simple. It's a good way to secure some initial ticks sooner. So we'll enter this single T at the green DPI price, 56.4450. That's the price needed to cause this bar to close, which would be the same as one tick above the high or one tick above the close. So, or the close of this bar. All different ways to find the same number. Regardless, it would be our entry price. So single T we look to enter with an 8-tick profit target and a 22-tick initial stop with 3 contracts. So our first bar plots, we're halfway to our profit target. Now we want to adjust our stop from 22 to 18 ticks. Helps mitigate a bit of the loss in case we do get stopped out. Shaves off about 12 ticks on the 3 contracts. So, and we know the market has moved 4 ticks toward our profit target because it takes 4 ticks in the direction of the trend to plot a new color bar. So we know that after the second color bar from our entry bar plots, we've hit our profit target. And one thing to note, especially if you're using an automated trade management in the DOM, I do like to set mine so that they will adjust to break even as soon as my profit target is hit, even if it's not filled. The way the ATM works, as soon as your profit target is hit, it will adjust your stops to break even if you have it set up that way. And we want to do that even on the profit target, because what can occasionally happen, it's happened to me a few times, is the price will come up and just kiss your profit target, doesn't fill, it just touches your profit target, and then the market reverses very quickly. So if it reverses fast enough and your stop wasn't at break even, you could have gotten stopped out on a trade that should have hit your profit target. Now if it adjusted to break even, well, it comes down and you get stopped out and you don't lose anything. So that would just be a scratch trade. So while it should have hit our profit target, not always going to happen that way. We can't always get filled. So something to keep in mind with your ATMs is we should set them to adjust to break even after the profit target is hit, just to be extra safe. So now we hit our profit target. We sell 2 of our contracts off at our 8 ticks and adjust the stop on our runner to break even. And then at this point, the market did take off. So at the close of the 4th bar, or once the 4th bar from our entry bar plots, that's when we can start trailing at the low of the previous bar. And it'll be the high of the previous bar if we're going short. And the reason we wait till this point is if we look at our entry price was 56.4450, the low of this bar is the first time where it is 1 tick above the high, or 1 tick above our entry price. And you may ask, well, if this is the low of this bar is 1 tick above the entry price, wouldn't the low of this bar have stopped us out at break even? No, not always, because this plots the range of the bar, and that doesn't always mean that the price actually went down that far. So in this case, it just took off. We adjust to the low of the previous bar at the close of bar 5, adjust to the low of bar 6 once it plots. Now we're up to 3 ticks. Now here is where we can widen to the DPI after the 6th bar from our entry bar plots, or roughly when the trade has made about $150 profit. We can widen to the DPI. And we'll use the opposite color DPI because we can't actually put an stop ahead of the market. So in this case, our stop would be 56.45. So we're 2 ticks better than our entry price. Now we do give up a couple quote-unquote secured ticks to widen it to the DPI, but it does have its benefits. But before I get into the benefits, I'll just go into the one thing that may look like a drawback to most people is that there will be times when we get to the point in a trade, like in this example, bar 7 just closed. I widen my stop to the red DPI, and the next bar is a turn bar. Stops me out. Now my runner only made 2 ticks as opposed to 7. So I gave up 5 ticks that I would have had if I would have left my stop where it was. All right, so what are we talking about here? 25 bucks in the NQ, right? That's 5 ticks times 5 ticks, or 5 ticks times $5, 25 bucks. So to me, it's worth giving up that 25 bucks that isn't even mine yet, because I'm not out of the trade. It's worth risking that in the event that the market just takes off and we get a nice runner. And so after every bar plots, I'm going to adjust it to the new DPI, which will essentially be moving it up 4 ticks. And this wick wouldn't have come down low enough to stop us out at the low of the bar even. So that one's fine. We would have rode over that one, no problem. But here is where, in my mind, the main benefit comes from, is that eventually, in this case, if I'm trailing at the low of the previous bar, I'd be at the low of bar 18. I get stopped out by here, and then I have to make another decision. Do I want to hop back in on this? Has this run out of steam? And for me personally, I like to make as few trading decisions, or I like to make as few decisions as possible when trading. So widening to the red DPI, I ride over this wick, and then the next bar stops me out, and that's fine. Now, if I was at the low of the previous bar, I get stopped out here, and if I decide to hop back in here, well, then I get stopped out right away, and I actually lose ticks and probably, give up some of this profit I already secured. Now, sometimes runs will go farther than 19 bars, of course. So we won't know when those times are, when a momentum would stop us out and it's at the end of the run, or when we should hop back in a momentum when it's late in a run, or when the run's gone on quite a bit, and it could still go on another 10 bars. We don't necessarily know. But I like to avoid that situation of guessing or having to make that decision altogether, and widening to the red DPI lets me take part from here to here. So just kind of the pros and cons of the money management strategy. So of course, use whichever one works for you. I do think that over time, the widening to the DPI gives us the best potential to maximize our profit, because we give ourselves more opportunities to take part in more runs, rather than trailing a bit too tight at the low of the previous bar, where you can come down and get wicked out fairly easily. But again, I just like to avoid that altogether. So pretty decent day in the NQ so far. That wasn't quite a divergence, so we could get in here possibly. Let's see, DPI 56, 34, 50. So that's 6, 7. So we do have just 7 ticks between the high of the day here for this one. So and since we're close to the high of the day, we want to keep in mind you want at least your profit target plus a tick of space, or you want to see your purple line outside of the neutral zone. And the reason for that is that's our rule for a breakout trade. So let me bring my rules up here real quick. Let me find these guys. All right, there we go. All right, so I see my rules for a breakout. One of the main ones is my purple line is outside of the neutral zone in the correct direction. So if I'm trending long, I need to see my purple line at plus 50 or above. So the reason we look for our blue line to be outside of the neutral zone for just normal trades when we're heading into the high of the day is because we don't want to enter a trade here that doesn't hit its profit target before it pushes through the high of the day, and then it just becomes an unqualified breakout. Even though we're on the tail end, we don't want to enter a trade that soon becomes an unqualified trade situation. So that kind of gives us some extra confidence when heading into the high of the day. Not 100%, not guaranteed to avoid those losing trades that bounce off the high, but it does give us a little extra qualification. So NQ, couple continuations can grab profit targets off of. No runners, but still that would have made up mostly for this losing momentum right here, and then we can catch in a bit of a run. Do catch a stop right here, which I don't think was close enough to the high. Yeah, it looks like there was 10 ticks of space here, so couldn't really avoid this one. Would have got stopped out. Can hop back in on this one. Probably take part in the most of that run. Catch another one near the high. So when I see this, I do get a little suspicious of the high of the day. If I've noticed that the price is bouncing off a few times. And I'm a little more hesitant when heading into the high of the day. All right, so of course, everyone, feel free to holler out some questions if you have any. Let me just grab another chart here. Just give me a second. All right, and let's take a good look at our friend the TF. So excellent picture of chop here. So just give me 1 second. Let me grab a drink of water real quick. So opening bell or vertical white line will indicate the opening bell. I usually like to check out the markets or open charts at least 5 minutes before the open so I can kind of do a quick scan, see what's going on, assess the situation. And right off the bat, TF is looking kind of choppy, right? No clear trends from the overnight or early morning session. Got the 200 coming down. All my EMAs are kind of getting bunched together. And so when I see this happening, notice my EMAs, my 200 and my other EMAs are kind of creating this funnel, and eventually we get to something like this. Well, whenever these are converging like this, that to me is a death spiral, and I'll avoid this situation like the plague because, as you can see here, very clear signs of chop, but the price just is bouncing around in between these EMAs. So we have kind of two levels of support and resistance that the price is just bouncing, bouncing, bouncing. And this situation is just way too risky to trade. Not that there was anything qualified in this particular area of chop, but sometimes there will be. But if it's in this range, and I've noticed that it just has bounced up a little bit, and you can see it's not pushing through the 200, so we never really know when that's going to be. But this is just telltale signs of chop. We have a lot of turn bars close together, EMAs right on top of each other. The price stuck between the different sets of EMAs, bouncing back and forth between the 200 and the 50, with the 10 and 20 kind of roped around the 50. Blue line not heading back and forth to extremes. You see right here is the last time it peaked out of an extreme, and then it starts bouncing around in between here. Really good sign of chop. And then my purple line kind of hovering around the zero. It's not too strong here. Dips a little bit out, but not too far. And same with the super trend. You see the super trend back and forth right around the zero line. So all four of those signs put together clearly tell us that there's chop. And we don't want to trade in a choppy market. And I think the reason is pretty simple and obvious when I think about it like this, is that most of our trades are trend trades or counter trend trades. So why would I want to enter a trade that isn't setting up when there's or why would I want to enter a trade when there's no indication of a clear trend, right? If I'm looking for trend trades and there's no strong trend, there's probably not going to be a good trade. So I think that makes sense. Pretty simple, straight to the point. But I do like to stress this, and you'll probably notice this a bit more now if you really start to watch for it, if you don't already avoid it already. But when I see the 200 coming down and the other EMAs all converging on it, that is bad news, and I will just avoid that. And oftentimes I find I can avoid quite a few losing trades that way. I may miss out on a profit target here and there, but to me it's not worth risking hitting a profit target compared to getting stopped out 2 or 3 times. That just does not make sense any way you look at it. So glad we can take a look at that. Usually don't have very many such clear signs of chop. And then the TF has a pretty strong breakout here, which we could enter. And I would not enter a trade until we were clear of the 200 one way or the other. You want to kind of make sure we can get out of this range here. And then everything kind of corrects and we see the EMAs start fanning out better. And then we could still potentially be in this trade right now. After about 6 bars, we'd widen to the red DPI right over this one. And then still be in here because we know our stop right now would be at 1413.1. So not a ton of trading opportunities in the TF, but a pretty good run here. But now it looks like it's just kind of stalled out. So. All right. And of course, guys, if you guys have any questions, feel free to holler them out. There are no bad questions. We want to make sure everyone is on the same page and up to speed. And you never know, your question may help jumpstart someone else and get them up to speed quicker. So if you ran into any trading situations earlier this week that were a little bit questionable, or if you found a what looked like a good setup but ended up going against you, and you want to know if there's ways to avoid that. Sometimes there are, and it's not really things that uh, are always evident right away. But sometimes there can be things that can help us stay out of trades that are qualified, but while they are qualified by the rules, the market conditions may not be the best to take that trade. So while we do want to qualify everything strictly by the rules, there can be other clues that tell us, much like just watching for market chop. A few of the things I do look for, especially with momentums, as at times the momentums can be a bit riskier. Uh, One thing I look for on the momentums is the previous leg length. So if I have, let me see if I can find a good example of this, because I think it'll be really helpful to everyone. So just give me a second. Let me. Well, maybe not today. No, all right, that's all right. All right, so one of the things I like to look for is the previous leg length. We'll just kind of use these, even though this was before market, but it can kind of illustrate the point here. So if you're not familiar, there's kind of a common I guess rule or strategy. I don't know what you'd call it, but it's called Elliott wave theory. We don't really subscribe heavily to it, although I find this is a common thing that people look out for, is that usually a run will have 3 legs, and after that it tends to run out of steam, so the fourth one seems a bit risky. So if we have 3 continuations or a single T followed by 2 continuations in a row, and then we get a fourth setting up, keep in mind that may be a bit risky. And oftentimes the leg length will correlate to the previous leg length. I think it's something like 70 to 80% of the previous leg length. So it's not always true. But in this example, if we look at this first leg went 14 bars. So this one, the second one, I get this momentum entry. Let's say I'm okay to enter it. My purple line, whoops. It is at minus 51, so I could enter this as a momentum. And that's fine because I'm at bar 5, and the previous leg went 14 bars. I feel pretty confident I can at least move 6 more ticks, right? In this case, it does move quite a bit farther. But once I get to this point, I'm past bar 14. I'm not really very eager to take any momentums past that point, or even before that point. I would say bar 12 would probably be my limit, because by then it'd be a bit risky for me to hit the 6 ticks. If it goes the same distance, I may, but at some point it does get a bit riskier than if it happened earlier in the run. And then our third run is much shorter than the previous ones, and then we just get a reversal. So little tidbit that I think can help people not get so stressed about the momentums. I know those can sometimes be a bit nerve-wracking sometimes, deciding when you should enter them, especially if you're getting a lot of pullback and retracements in the middle of runs. Sometimes we'll get into these situations where you have 2 or 3 weeks in a row, and you just keep that in mind. If I see that as a common occurrence in the market for a couple days here and there, I'll probably be a little more cautious of momentums, but overall still a profitable trade setup. Next, I would like to cover a surf trade here. So surf trades are our new setup. Let me see if I can find a good example for you guys. Now, surf does have a lot of overlap with the momentum trades. But there are some times where it really shines in a different manner. And let me see if I can find a decent example of that for us here. Just give me a second. Sometimes trying to find these perfect examples. Well, here's a pretty decent example. So not the longest run in the world, but still a good example of when these surf trades really, I think, shine. So while surf trades do have quite a bit of overlap with the momentum trades, most momentums that qualify, especially ones later in runs or during strong trends, would also qualify as a surf. And that's fine. I don't find that it really bolsters the qualification that much. But anyhow, where I feel the surf trade really shines are on these reversals. So coming off the end of a long short trend here, market starts to reverse. We don't have a divergence reversal set up here. So our blue line hasn't diverged enough, even though our super trend is pretty bloated there past the extreme. But instead we just get a nice normal market reversal here. And this bar with a tail here is where we can enter our surf trade. So the rules for the surf trade are pretty straightforward. I'm looking for the blue line to be above the purple line, and the blue line also needs to be outside of the neutral zone in the correct direction, or in the same direction I'm looking to take my trade. So if it's a long trade, it needs to be outside of the neutral zone on the positive side. Short trade, it needs to be outside of the neutral zone on the negative side, and also below the purple line. So in this case, my long rules are set up. It is outside of the neutral zone and above the purple line. Next, I need to see my super trend outside of the neutral zone. Now, this is the part where I think is a little counterintuitive to people, or a bit different from our other rule sets, is that the super trend just needs to be outside of the neutral zone. It does not matter which direction, if it's positive or negative, just that it's outside of that zone. And then we just need to see a bar. We can enter on a bar with a wick. It could be a purple bar or a turn bar even. As long as that bar has a wick, we can enter it. And we'll still enter at our green DPI price if we're heading long. And we follow the same money management rules as the momentum trade. So you can think of it as a kind of variation on the momentum trade, but it really gives us these new opportunities. This one looks like, we would have just hit profit target and possibly grabbed an extra tick on the runner. But I'm sure there have been plenty of times where we see these nice market reversals, and they just keep going, right? We came down off a long trend, and then everyone says we're tired of going short for the day, and the market just keeps chucking all the way up. And these surf trades let us get in on those. Not everyone, of course, but it does present these, which were previously missed opportunities because we didn't really have a good way to indicate when it's a good idea to get in these reversals. But the surf trade allows us to do that, and it has quite a bit higher win rate than the other trades. It is a bit more, I mean, it's definitely less infrequent than a continuation or single T or momentum, but you'll still see them, 4 or 5 times a week on any given market. Maybe a bit more, maybe a bit less, depending on, how much the markets are moving. But it does present us some nice additional opportunities to hop in. And no longer do we have to ask ourselves, how could I have gotten in this run? Or why are you leaving this money on the table? So that type of thing. So typically a good trade, there's actually a losing one there. And of course, they're not impervious to loss, but overall they do have quite a high win ratio. So all right, everyone, we're down to about the last 10 minutes. I will stick around for a couple minutes over. We got started about 5 minutes late. Please feel free to ask any questions, anything at all. There are no bad questions. I do want to make sure that there is no confusion anywhere. I know sometimes, everyone understands and learns things a bit differently. So the way I normally explain things, I try to tailor it toward questions I've heard before or common things that I found that might get a bit lost in translation with the way the rules are written and that type of thing. So I try to tailor it or explain it in a few different ways. But of course, we all understand and learn things a bit differently. So if something's still unclear, please feel free to throw a question out there. Make sure we get everyone up to speed and trading profitably with Pro9 Trader. So till then, I'll go ahead and bring up our good friend, the EMD. Again, in the EMD, similar to the TF, we had some chop. Again, we can see that same range coming, this little funnel of price action. Couldn't get in here because our entry is right on the 200. Universal rule, we do not take trades into the 200 EMA. It is just far too risky. You never really know when you're going to push through the 200 or just bounce off of it. So definitely a bit risky. EMD overall just kind of choppy in the morning. Here we have the EMAs all roped together. Blue line bouncing around the middle here, not really consistently getting to extremes. So definitely some strong signs of chop in the beginning. Possible breakout here, but might have been a bit too risky. I probably would have skipped that one. Just coming out of this, trying to push through the high and then the 200, even though it's far enough away, some situations to me are I just feel are too risky. Then we get into some more chop here, trading into this range between these EMAs. And then finally we push past the 200, and this is the first chance I would try to hop in on this breakout. So once I see a trade win without me, I feel that's a pretty good way to determine if we're returning to normal trends or a decent cycling market, is to watch a trade win without me. Kind of lets me know that we're probably moving out of chop. So even though this continuation did win, I still wouldn't enter this next one because we're right on the 200. Could very well bounce off. But once we clear the 200, then I'm definitely more confident about entering a trade. And specifically a breakout, because once you get into this situation, if you push past the resistance here, and if you're able to push past the high of the day, which we enter at one tick above the high of the day, sometimes all we need to do is just get that one tick and the market will take off. So, and then again, we could be in a situation trailing at the red DPI, could still potentially be in that trade. Have to update this. So, which wouldn't be too shabby for the EMD. I mean, the EMD, since it's one of the only $10 per tick markets we trade still, you know, sometimes all you need is one good trade in the EMD, and I might pack it up early for a Friday. Let's see, some other things I would like to touch on real quick. Is that the Russell is moving to the CME group. So I guess it will appear on the ICE exchange as well. So there will be the Russell available in the CME. The symbol will be RTY. And you will have to update. There's a manual update process to add that instrument. But for those who have been kind of sitting out of the TF because it was on the ICE exchange, it was quite a bit more for the data feed. 117 bucks. So added to the CME group, I'm sure it'll be quite a bit cheaper if it's not just included in the bundle. All right, we got a question. An email that was sent out a few weeks ago. It indicated that along with some new stuff that there was an improvement on win-loss ratios. Where can we get the info on what those improvements are and we should implement? So I believe the email you're referring to was either talking about the surf trade particularly or the advanced training from Pro9 Live. That's a training course developed by Scott. It's about 3 hours long and goes over all of his additional qualifiers, things he looks for to stay out of riskier trades, and also things he looks for that qualify the trades a bit more strongly. So these are all above and beyond what we usually teach. These are all kind of his things that he's found work really well for him in the trading room, which can be reflected by his running stats for the last 30 days. He's been pretty positive. I think he's currently still up over 5 grand or something for the last 30 days. So those are all his. You can check over to Pro9 Live. There is an additional charge for the advanced training, but once you have it, you have it. You can review the videos as much as you want. They are broken down into modules for you. And there's a ton of information there. So Scott has quite a lot of little details that he looks for when he trades. So, and they overall do go quite a ways to avoid some of the riskier trade setups. So And 3 hours of info does sound like a lot, and it is, but remember, it's not all stuff you have to implement right away. I mean, if you try to take 3 hours of information and cram it into your trading right off the bat, you might be a little overwhelmed. I know I would be trying to remember all the little details that could help me, you know, avoid losing trades, that type of thing. So what I mainly do is just, really pay attention to chop. Um, and look for those patterns. The 200 and the rest of the EMAs kind of funneling together. That's a strong sign, and just avoid that like the plague. Um, keep an eye out for the other indications of chop. Uh, I find just that type of stuff is fairly effective at reducing some of our losing trades. Um, I'm definitely a little more skeptical of, if there's been three decent runs in a row. I'll usually pass on the fourth one just to see, because sometimes we get little head fakes in there like this, and then a short reversal, and then the market starts trending long again. So I feel like that's strong enough in the beginning to help disqualify enough losing trades. So, and of course, depending on your personal trading style and account size, that also affects how uh, maybe cautious you are with trading in general. And like if you're starting slow, that's another thing is, when people first start, I think there's probably maybe a pressure some might feel to take every trade right out of the gate immediately. And long term, that is a very effective strategy. Uh, but you might run into some days that hurt a little more than others, like everyone does. So if you're not prepared for that mentally, that can really kind of affect your judgment, um, which is why I'm of the opinion I like to start small, start slow, and shoot for a decent daily profit target that I feel I can hit consistently. That way, I don't have to stress about taking every single trade right away. I can slowly build my account up, maybe add a contract after I, accumulate $3,000 of profit for the account. And you can do that within 15, 20 days just shooting for a $200 profit target. And then you just kind of slowly build things, and then eventually they start to snowball. Once you get to the point where you're trading 5 contracts, and you'll have three for the profit target and 2 for the runners, that's when things really start to snowball, and you can accumulate a good amount of profit very quickly. And then if you're shooting for $500 a day, sometimes you can make that in one trade and be done for the day. And I don't know about all of you guys, but I would love to hit my daily profit target for the day and then just be done within the first 45 minutes. Does happen. So some things to keep in mind, and if you haven't checked out the trading room, you may want to give that a look. They do have a $17 trial for 5 trading days. And that's over at pro9live.com. So Scott has been doing very well consistently and has remained positive for the last 4 or 5 months now, if not longer. So if you're looking for some additional insight, the trading room is a good place to get that. So Scott does cover quite a bit of information, and whenever there's downtime, he does put in some education as well. So it's not just him calling out trades. He also does try to educate and improve everyone's trading through that. So, oh, Mike is asking the ATM strategies. There hasn't been any changes. Not really. There are a few details I do need. I have quite a few videos I'm in the process of updating, so that one is on my list. Let me go ahead and just show you. And if you want some like screenshots or something, shoot an email to support and I can send you screenshots of this as well. But let's see, let me get my Pro9. One of the main differences, let me see here, is I have my first profit target. I put the auto break even to hit my profit target. I think you might have slipped in here after I was done talking about that, Mike, but I like to have both these set to auto break even in the event that say the market's moving rather quickly and the market comes up, kisses my entry price, and then reverses before that, or before my profit target gets filled. So it kisses my profit target, drops back down before it had a chance to fill those. So I haven't actually made my profit target yet. And then if the market reverses fast enough and we don't adjust our stop to break even, we can get stopped out in what would otherwise be a winning trade. So having these both set to our stop strategies, having them both set to auto break even, and you just put whatever your profit target is in here. That way, if that situation happens, although it's fairly rare, but sometimes, you know, depending on how fast the market's moving, I'd rather end it as a scratch where it's just zero than risk getting stopped out. So that's probably the only thing I'll be updating. I don't think there's really been any other updates to the ATM. We still follow the same money management strategies. Haven't adjusted any of that. So yeah, that's all I can think of. And if you're following the route where you're adding more contracts eventually after you hit $3,000 of profit or whatever that may be, the best ratio we found is favoring 2/3 of any number of contracts you're trading for the profit target and the remaining contracts for the runner. So always favors 2/3. So if you're trading 5 contracts, you'll have 3 on for the profit target and then leave, or you'll take 3 off at the profit target and leave 2 on for the runner. If you're trading 6 contracts, we do 4 at the profit target and 2 for the runner, so on and so forth. So that's a very effective way, especially once you start scaling up contracts. So, and if you do that, keep in mind you do want, the more contracts you trade, you want to trade a market that has enough volume. I like the EMD. I know people complain about the low volume on that, and I totally get it. I mean, we're all in the same boat. We catch slippage too on the EMD. There's not much. I would probably stick with like 3 or 4 contracts on the EMD personally, just because it doesn't quite have the volume of the other larger markets. So, all right, everyone, we're at the end here, so if there are no last-minute questions. Oh, Mike's asking, is there a way or trick to flipping back and forth between the 2 main ATMs depending on what signal you get? Not really. The only way is to change it from the drop down, and once you're in one, I would not suggest doing that because that can kind of mess up the ATM. So what I do is it depends where I'm at. So I know what kind of trades qualify where. So all the ones that use an 8-tick profit target and 22-tick stop, those all qualify on turn bars. So I know if I'm waiting for that type of setup, like if I'm in this position here and I see, well, my EMAs are still almost in order, could be close. may possibly have a single T. So I know if I'm waiting for a single T, or I'm in that kind of situation where I'm not going to get a momentum long, I'll leave my profit target as the 820, or my ATM as the 822. And then when I have my turn bar plot, if I'd entered ahead of time or if I go for a retracement, I'm still on the correct money management strategy. As soon as I get to a point, say where I'm after this first color bar, because we don't enter any of those trades past the first color bar. It's either a turn bar entry or the first color bar entry. After that, it's too late. And that's if it qualifies. Of course, we can go for a retracement, but so if I'm after a point where I'm going to get an entry for my single T, continuation, divergence, or dot trend, if I'm past that point, now I'm in the middle of a run. Well, what kind of trades pop up in the middle of a run? My momentums. So if I'm at this point and I'm looking for possible momentums, that's when I'll switch my ATM just to be prepared. So it's one of those things that you just got to kind of keep an eye on and make mental notes, and then you'll find a rhythm to it with just practicing that. And this comes with anticipating the trades as well. When you get really good at anticipating what kind of trade setup you may be coming on the horizon, then you can change that ahead of time and be prepared for that. And then, say, well, if this doesn't qualify as a continuation by the first color bar, I'll switch my ATM and wait for a momentum. So, and I always like to have a plan of action for the next bar. So even the one that's currently building and the one after that. So just so I can have a few action steps for myself and say, well, if this does qualify, I'm going to go for a retracement. If this doesn't qualify, I'm going to switch my ATM strategy and wait for a momentum setup. So that's really the best way I found to do it, and works for me really well. And just after you keep reminding, I mean, there may be a few times when you're doing it and you have the incorrect money management strategy in. But, it's only going to take a few times for that to happen before you remind yourself. And also, as an additional note, you can change this before the order's filled. So if you put your entry price in, the order's not filled yet, and then you notice, oh, I have the wrong the ATM strategy, you can just come and change it real quick. So as long as it's not in the trade before it happens, you'll be fine. All right, excellent. Glad we got that cleared up for you. Again, everyone, thank you for joining me. I hope you're able to walk away with a little more info than you walked in, and can apply some of it to your trading to help increase your daily profits and overall success with Pro9 Trader. If anything else pops up or you guys have any questions, feel free to shoot us an email at support@academydaytrading.com, and we'll be happy to get those questions answered for you as soon as possible. All right, everyone. Hope you have a wonderful weekend. Hope the rest of the trading day treats you well and you can catch a few more good runs before the end of the day. And until next time, happy trading.